March was another month of high volatility, with market movements driven mainly by politics rather than economic trends. A quick review of the month and an update on the outlook for April. Stock markets are a good barometer of sentiment and a measure of business profitability. So the rises over the last year, especially in the US, showed how buoyant confidence had become, notably technology and tech stocks. The tech-rich NASDAQ index rose over 28% last year, and then another 7% in January alone. So when the correction in stock markets started in February, mainly over concerns of rising US inflation and interest rates, the NASDAQ fell sharply along with the rest of the indices. The recovery after that initial shock was messy, but a new record was seen in March before the next wave of selling, driven this time by announcements of US tariffs, sparking fears of a global trade war. That all appeared to be an overreaction, given how small the tariffs were compared to the total trade market and the number of countries exempted from the US tariffs. But the latest news seems to indicate this was all a part of the US administration trying to protect its technology industry and related intellectual property from Chinese investment and supposed unfair practices. Less Chinese investment won't help the value of US tech stocks, which were already under pressure in the wake of the Facebook privacy scandal. So the outlook for the broader market is uncertain. However, while we hold above February's lows, it still looks like a correction rather than a complete reversal, especially given the strong global growth outlook. Nevertheless, it's a late cycle, mature bull market and will end at some stage as US rates rise. Local markets have also been skittish given our dependency on international trade. So the Aussie dollar has been doing the right thing by falling towards the bottom end of its 75 to 81 cent recent range, which does help a range of local businesses and export markets. And that fall is despite the US dollar itself remaining weak, as we expected. Our currency is therefore much lower against the yen, the euro and the pound, which would please the RBA. As they've said for some time, a stronger exchange rate works against a pickup in economic activity and inflation. We see the potential for further falls against the yen and the euro, but for the Aussie to the US, the 75 cent level may still be a floor, at least in the short term. And speaking of our Reserve Bank, expectations of interest rate rises by year-end have been unwound to a degree, thanks to volatility in the markets, a slight miss on our GDP growth at only 2.4%, and the threat of increasing trade tensions between the US and China. As the chart shows, rate hikes are looking less likely than they did a month ago, which should help to maintain business and consumer confidence, as well as adding stability to the housing market. So going into April, the jobs market remains healthy, and we'll see on April 19th if any signs of wages growth is emerging there to complement employment growth. Plus, we'll get an update on inflation with CPI out on the 24th. Ahead of that, we'll keep an eye on stock markets, which will still be at the mercy of political developments, global tampering rather than ball tampering, and see if the ASX 200 index can remain above 5,600, the lows from mid last year, to encourage another year of solid returns for our super funds. Until next time, that's the market update from Bendigo Bank.